All right, friends, let's carry on our journey of the lazy man's way to find out how to generate income during recession. Welcome to video lesson 12. Mansoor Suhail, your instructor from my learning center, welcomes you. So what is our main focus of this module? Main focus in this module is, where is your money safe during recession? So let's dive in. Fund types to use during recession. The ebb and flow of the economy. My friend, when an economic slowdown or recession rears its head, it can send shivers down the spines of even the most seasonal investors. Trust me. So during these uncertain times, the prevailing wisdom often whispers in our ears, urging us to shift our focus from equity funds to the comforting embrace of fixed income investments. It is like a gentle hand guiding us towards financial stability amidst the storm. In time of economic turmoil, equity funds can resemble a roller coaster ride with unpredictable twists and turns. The stock market becomes a tempestuous sea, causing prices to sway like leaves in the wind. It is no wonder that some investors feel a tinge of unease in their hearts. This is where fixed income investments like bonds and certificates of deposits come into play. Fixed income investments offer a safe haven, providing a sense of security and stability when the world around us feels uncertain. They can be like a warm blanket on a chilly evening, providing a steady stream of income that helps ease our worries. While they may not offer the accelerating returns of equity funds, they provide a reliable foundation for your financial journey. However, my friend, before you make any hasty decisions, it is important to consider your own unique financial goals and risk tolerance. Always do that. Each investor's situation is as unique as a fingerprint, and what works for one may not work for another. If you are a young and adventurous investor with time on your side, staying the course with equity funds might be the path to consider. History has shown us that the stock market has a remarkable ability to bounce back, rewarding those who weather the storm. But on the other hand, if you are approaching retirement or prefer a more serene path, fixed income investments can offer a sense of calm. They may not make your heart race with excitement, but they provide stability and steady income stream. They are the gentle lullaby that helps you sleep peacefully at night, knowing that your nest egg is protected. So remember, my friend, the key lies in diversification. Just as a painter uses a palette of colors to create a masterpiece, a wise investor spreads their investments across different asset classes. By doing so, you can navigate the uncertain waters of economic slowdowns and recessions with confidence, knowing that you have built a resilient and balanced portfolio. When in doubt, always seek guidance from a trusted financial advisor who can help you navigate these turbulent times. Together, you can craft a personalized strategy that aligns with your goals and aspirations. So take a deep breath, my friend, and remember that every storm eventually passes, leaving behind opportunities for growth and prosperity. A strategy for any market? Absolutely. Building a diversified mutual fund portfolio is indeed a far better strategy to navigate the ups and downs of the market. It is like creating a beautiful symphony where each instrument plays its part to create a harmonious melody. By constructing a portfolio that consists of a mix of both stocks and bond funds, you can enjoy the potential for growth in the stock market while also having a cushion to protect your portfolio during market declines. It is like having the best of both worlds. Imagine your portfolio as a well-curated art collection. Each individual fund represents a unique piece of art, carefully selected to contribute to the overall balance and beauty of the collection. Just as different art forms evoke different emotions, various fund types offer different levels of risk and return potential. The key is to find the right balance that matches your desired asset allocation. Think of it as a recipe for financial success. Just like a master chef combines ingredients in the perfect proportions to create a delicious dish, you can select individual funds in a way that aligns with your financial goals, risk tolerance, and time horizon. But remember, my friend, constructing a portfolio is not a one-time event. It's an ongoing process, much like tending to a beautiful garden. You need to monitor and adjust your portfolio periodically to ensure it stays in line with your changing financial circumstances and market conditions. This is where the expertise of a financial advisor can be invaluable. Your financial advisor can determine the right asset allocation for your unique situation, select the appropriate funds, and guide you in making adjustments as needed. Together, you can create a portfolio that reflects your aspirations and helps you achieve your financial goals. I completely understand why risk-averse investors often turn to certain kinds of bond funds for peace of mind and a sense of security. When it comes to safety, funds made up of US Treasury bonds are frequently seen as the gold standard. US Treasury bonds hold a special place in the hearts of risk-averse investors because they are considered one of the safest investments out there. The reason behind this is rooted in the trust and confidence placed in the US government. As an investor in US Treasury bonds, you face no credit risk because the government has the power to levy taxes and print money, which eliminates the risk of default. Think of US Treasury bonds as a sturdy shield that protects your hard-earned money. They provide a level of principal protection that can help you sleep soundly at night. It's like having a safety net beneath you, ensuring that even in uncertain times, your investment remains relatively secure. So by investing in US Treasury bond funds, you are essentially placing your trust in the stability and reliability of the US government. This trust is built upon the belief that the government has the means and resources to meet its financial obligations. For risk-averse investors, this can bring a sense of comfort and reassurance. It is like having a reliable friend by your side, someone you can count on to keep your best interest at heart. However, it is important to remember that no investment is entirely risk-free. I emphasize, no investment is entirely risk-free. While US Treasury bonds are considered to be one of the safest options, they still come with their own set of considerations. For example, they may not offer same potential for high returns as riskier investments. Additionally, changes in interest rates can affect bond prices, which can impact the value of your investment. Your financial advisor's role is to help you navigate these nuances and make informed decisions. He can assist you in understanding the benefits and trade-offs of different types of bond funds, including US Treasury bonds. With his help, you can create a strategy that aligns with your risk tolerance, financial goals, and desire for stability. So whether you choose US Treasury bonds or explore other bond funds options, ask your financial advisor for guidance and support along the way. Both of you should work together to find the right balance that allows you to achieve your financial objectives while staying true to your risk preferences. Money market funds. Indeed, my friend, when it comes to avoiding recessions, bonds tend to take the spotlight. But it is important to remember that they are not the only option available. For ultra-conservative and unsophisticated investors seeking a higher degree of safety, money market funds often become their go-to choice. These funds offer a sense of security, but it is crucial to understand that they are best suited for short-term investment purposes. Like a reliable safety deposit box, provide a place to stash your cash while still earning some level of return. They are designed to invest in low-risk, short-term securities such as treasury bills, certificates of deposit, and commercial paper. This conservative approach aims to minimize the potential for loss. While money market funds carry a greater risk compared to funds that invest in securities backed by the federal government, they are still considered relatively safe. It is like having a solid foundation beneath your feet during uncertain times. However, it is important to note that no investment is entirely risk-free. The key to utilizing money market funds effectively is to have a clear understanding of their purpose. They serve as a temporary parking spot for your cash, providing liquidity and stability. They are not intended to be long-term investments that generate significant returns. For ultra-conservative investors or those with short-term financial goals, money market funds can offer peace of mind. They provide a safe haven for your cash while still allowing you for easy access when needed. It is like having a reliable friend you can rely on for short-term financial needs. I encourage you to consider your investment goals, time horizon, and risk tolerance when deciding whether money market funds are suitable for you. It is important to have a well-rounded portfolio that aligns with your specific financial circumstances and aspirations. So remember, my friend, financial decisions are personal, and what works for one may not work for another one. But taking the time to understand your unique needs and working together with your financial advisor, you can definitely create a balanced approach that guides you towards your financial goals while keeping your peace of mind intact. So discuss it with your financial advisor and explore the world of money market funds and determine if they are right fit for your short-term investment needs. Trust me, working together with your financial advisor, you can navigate the ever-changing landscape of finance and find the optimal solution that aligns with your objectives. Let's talk about municipal bond funds. Municipal bonds, my friend, are a unique investment opportunity that brings together the strength of state and local governments with the desire for safety and security. These bonds are issued by state and local governments, and they offer a special kind of investment that can resonate with risk-averse individuals like yourself. When you invest in municipal bonds, you are essentially leveraging the local taxing authority of governments to provide a high degree of safety and security. It is like a partnership between you and the community, working together to support important projects and initiatives. These bonds are backed up by the taxing power of the issuing government entity, which adds an extra layer of reassurance. You can rest easy knowing that the government has the ability to raise funds through taxes to meet its financial obligations. What is particularly appealing about municipal bonds is that they offer a range of options to suit different investors. You can choose from various types of municipal bonds, including general obligation bonds and revenue bonds, each with its own unique characteristics and risk profiles. Imagine investing in a municipal bond and knowing that your hard-earned money is being used to build schools, hospitals, roads, and other essential infrastructure in your community. It is like planting seeds of progress that will benefit not only you, but also future generations. But let us not forget that, like any investment, municipal bonds do come with their own set of considerations. While they generally offer a high degree of safety, it is important to assess the creditworthiness and financial health of the issuing government entity. This helps ensure that your investment remains on solid ground. Your financial advisor can guide you through the process of evaluating municipal bonds, considering factors such as bond ratings, tax implications, and your own investment objectives. Together, you can find the right balance that aligns with your risk tolerance and desire for safety and security. So seek advice from your financial advisor for exploring the world of municipal bonds and discovering the potential they hold. Together, you can build a portfolio that not only offers stability and security, but also contributes to the growth and prosperity of your community. Dividend funds. My friend, when it comes to the stock market, many investors have a stereotypical view that it's solely a vehicle for share price appreciation and instant prosperity. But let me tell you, there is a whole world of opportunities beyond just watching those stocks prices skyrocket. Let us talk about mutual funds focused on dividends. They are like hidden gems in the stock market, offering a unique avenue for potentially higher returns with less volatility. These funds are designed to invest in companies that consistently distribute a portion of their earnings as dividends to shareholders. Now, you might be wondering, what is so special about dividends, right? Well, my friend, dividends are like little financial rewards that companies share with their investors. It's like receiving a steady stream of income, a cash flow that can provide stability and even a sense of reassurance during turbulent times. With dividend-focused mutual funds, you have the opportunity to participate in the income stream while potentially benefiting from the growth of the underlying companies. It is like having the best of both worlds. Potential for capital appreciation and a regular paycheck from those dividend payments. These funds often invest in established companies with a track record of consistent dividend payments. They tend to be more stable and less volatile compared to funds focused strictly on growth. This can be particularly appealing for investors who prioritize income generation and are seeking a smoother ride in the stock market roller coaster. Now let's not forget that investing in dividend-focused mutual funds still comes with its own level of risk. Market fluctuations and individual company performance can impact the fund's return. However, historically, dividend-paying companies have shown resilience and the ability to weather market downturns more effectively. And your financial advisor can help you identify dividend-focused mutual funds that align with your investment objectives and risk tolerance. He can explore different funds, analyze their track records, and consider their dividend yields and growth potential. Together, you can craft a strategy that embraces the power of dividends while aiming for long-term financial success. So, my friend, break free from the stereotypes and explore the world of dividend-focused mutual funds. By doing so, you can potentially unlock higher returns with less volatility and while enjoying the regular income that dividends bring. Work with your financial advisor to embark on this journey together and discover the hidden opportunities that lie beyond share price appreciation. Taxable corporate funds. When it comes to exploring investment options in the bond market, taxable bond funds issued by corporations are indeed worth considering. These funds can offer higher yields compared to government-backed issues. But it is important to be mindful of the increased level of risk that comes along with them. By choosing a fund that invests in high-quality bond issues, you can help lower your risk exposure. Taxable bond funds issued by corporations can be like a treasure trove of opportunities, offering the potential for attractive yields. These bonds are issued by corporations to raise capital for various purposes, such as expansions, acquisitions, or refinancing existing debt. Since they are not backed by the government, they can carry more risk than government-backed issues. So now, my friend, let us talk about risk. It is like sailing the high seas with unpredictable waves and shifting winds. But fear not. By selecting a fund that focuses on high-quality bond issues, you can navigate these waves with a greater sense of security. High-quality bond issues are like sturdy anchors, providing stability and a low risk of default. These bonds are issued by companies with strong creditworthiness, solid financials, and a proven ability to meet their debt obligations. Investing in these bonds can help mitigate the risk associated with corporate bonds. It is important to note that while these funds offer higher yields, they still carry a level of risk. For example, economic conditions, industry trends, and company-specific factors can impact the performance of corporate bonds. However, by choosing a fund that carefully selects high-quality bonds, you can potentially reduce the risk of default and increase the likelihood of receiving interest payments. So your financial advisor can help guide you in selecting taxable bond funds that align with your risk tolerance and investment goals. With his help, you can evaluate the credit ratings of the bonds held within the fund, assess the diversification and management strategy, and consider the fund's historical performance. By taking a thoughtful approach and being mindful of the risk involved, you can create a strategy that balances the potential for higher yields with the need for stability. Together, you can navigate the corporate bond market seeking out opportunities while keeping a watchful eye on the potential risks. So, my friend, set sail on this voyage, exploring taxable bond funds issued by corporations. By choosing high quality bond issues and employing a prudent approach, you can seek higher yields while mitigating risk. Together, you will chart a course that aligns with your financial aspirations and helps you navigate the vast ocean of investment possibilities. Let us talk about utilities mutual funds. Utilities-based mutual funds that focus on consumer staples are indeed a less aggressive stock strategy that can be an excellent choice for investors seeking stability and reliable dividends. These funds put emphasis on investing in corporations that pay predictable dividends, offering a sense of reassurance and peace of mind. Imagine these funds as a comforting oasis in the desert of uncertainty, providing a steady stream of income and a focus on stable companies. Utilities-based mutual funds primarily invest in companies within the utilities sector, such as electric, gas, and water companies, as well as consumer staple companies that offer essential products like food, beverages, and household goods. The beauty of these funds lies in their ability to capture the essence of predictability. Utilities and consumer staples companies tend to operate in industries with consistent demand, even during economic downturns. This stability can translate into reliable cash flows and, in turn, predictable dividends for investors. By investing in utility-based mutual funds, you can enjoy the benefits of both capital appreciation and regular dividend payments. It is like having a reliable income stream that helps support your financial goals while providing a sense of security. So, my friend, let's weave a story of empathy and creativity that captures the essence of these funds. Imagine a warm and cozy hearth where investors gather to find solace amidst the stormy winds of the market. Utilities-based mutual funds are like a comforting embrace, offering stability and reliable dividends. As the sun sets on a bustling town, the hum of electricity fills the air, and the scent of freshly baked bread wafts from the local grocery store. These are the companies that form the backbone of utility-based mutual funds. They are the steady pillars that provide essential services and products, ensuring that life goes on no matter the economic climate. Investing in these funds is like becoming a part of this vibrant community, where reliable dividends flow like a gentle stream. It is an opportunity to support companies that have a long history of providing essential services and products to consumers. Your financial advisor will understand the importance of empathy and creativity in crafting a financial strategy that aligns with your goals and aspirations. He can help you explore utility-based mutual funds, selecting those that focus on stable companies with a track record of predictable dividends. Together, you can create a story of financial resilience and stability, where reliable dividends serve as the protagonist. You will navigate the world of utilities and consumer staples, seeking out opportunities that align with your risk tolerance and desire for consistent income. So, my friend, embark on this creative journey, exploring utility-based mutual funds that brings stability and predictability to your investment portfolio. Trust me, together with the help of your financial advisor, you will build a strategy that embraces the beauty of reliable dividends while supporting companies that play a vital role in our daily lives. So, my dear friend, finally, hedge and other funds. For the wealthier investors seeking to diversify their portfolio and navigate various market conditions, exploring the world of hedge funds can be an intriguing idea. Hedge funds are specifically designed to make money regardless of market conditions, offering a unique opportunity for potential returns and risk management. Imagine hedge funds as skilled navigators of the financial seas, adept at charting a course through stormy weather. These funds employ a range of strategies, such as short selling, derivatives, and alternative investments, to potentially profit from both upward and downward market movements. They are like talented captains steering the ship of your wealth with a focus on capital preservation and growth. By considering an allocation to hedge funds, the wealthier investor can access a world of sophisticated investment strategies that go beyond traditional approaches. These funds often have the flexibility to adapt to changing market conditions, seeking opportunities across various asset classes and employing tactics to potentially generate returns. Now let us delve into the concept of foul weather fund. Just as a wise sailor prepares for stormy seas, having a foul weather fund in your portfolio can offer a unique advantage. These funds are specifically designed to make money when markets are in decline, acting as a safeguard against market volatility. Think of a foul weather fund as an umbrella that shields your investment portfolio from the rain of market downturns. During challenging times, these funds may employ strategies such as short selling, hedging, or investing in defensive assets to potentially generate positive returns or mitigate losses. They are like a secret weapon ready to be deployed when the storm clouds gather. You and your financial advisor should understand the importance of diversification and risk management in building a resilient portfolio. Hedge funds and foul weather funds can offer potential benefits, but it's essential to consider the unique characteristics, risk profiles, and sustainability for your specific financial goals. By embracing creativity and empathy, you can craft a tailored approach that aligns with your wealthier investor status and aspirations. Together, you will explore the world of hedge funds and foul weather funds, selecting those that fit your risk tolerance and investment objectives. Remember, my esteemed friend, that investing in hedge funds and foul weather funds involves careful consideration and due diligence. It is crucial to work with a trusted financial advisor who can guide you through the complexities and help you make informed decisions. So embark on this creative journey with a trusted and experienced financial advisor and explore the possibilities of hedge funds and foul weather funds. Trust me, together you can navigate the financial seas, seeking opportunities for growth and protection, and ensuring that your wealth sails smoothly through all market conditions. Thank you very much for watching. I will see you in the next video lesson.